Hi, Joe Kehrig with the Kehrig Real Estate Team, and we have a special presentation for you today. You've heard me talk a lot. Matter of fact, we did a video we talked about marry the house and date the rate. So people always ask me, what does date the rate mean? So it means like, okay, you want to marry something you want long term. You find the house of your dreams, you want to be there long term, you marry the house. You date the rate, like if you don't really like the rate, then in a couple more years, when the rates go down, you basically dump the ugly rate and get a newer, lower rate. Because what happens right now is as the government will push you into a recession, they raise the rates. So everything gets more expensive. So people quit buying and they slow the inflation down. And then once they want to pull us out of a recession in a couple years, then they lower the rate back down. So buy your dream house where you have great opportunities out there, get the ugly rate, then in a couple years, dump the rate, and then obviously marry the rate at that point. Once it goes back down, might not go back down to sub 3, but we definitely might see 4% or so again, 4.5%. So what do you do in the meanwhile? Sometimes people go, that sounds great, Joe, but we can't afford a 6-7% interest rate. Well, there's something that we call buy downs, and that's what I want to talk to you about. A buy down is where the seller, and we talk to our sellers about doing this because we can spend $30,000 or $40,000 buying the rate down for the buyers, and it's actually more effective than lowering the price by $100,000. So these are buy downs that the seller does for the buyer. And instead of maybe a price reduction, and it saves a buyer a ton of money and makes the home more affordable for qualifying purposes. For these slides that we're using today, we're working with GRA, Guaranteed Rate Affinity, which is the Coldwell Banker lending partner. So you see with the first slide, it talks about traditionally there were 2-1 buy downs, 1-0 buy downs, 1.5 to a half buy down, and now there's 3-2-1 buy downs and 1-1-1 buy downs. What does that mean? Well, a 2-1 buy down means that the seller is going to buy the interest rate down for the first year by 2 points and then 1 year on the second. Then the third, it's going to be whatever the rate is at that you got into. A 3-2-1 buy down, they're buying it 3% down the first year, 2% the second, 1% the third. Obviously, it's more expensive. The more you buy it down, the more the seller has to pay for that prepaid interest, because that's actually what's happening. They're prepaying the interest so you can get a lower interest rate. So what does that look like when we put it down? Well, here's an example of a 3-2-1 buy down. Now, this is based on a $660,000 loan. So for us, this is great because we do have a lot of condos and townhouses under $1 million and single family homes now that we didn't have before. But you can just obviously double this if you're looking at $1.5 million home or so. So you see what happens in year one. You go, if the interest rate is 6.625, year one, and your payment would be $4,200, over $4,200. Well, in year one, it buys it down to 3.6. Your payment is $3,000. So from $4,200 to $3,000. Then the second year, it goes to 4.6. Third year, it goes to 5.6. And the fourth year, it goes to 6.6. The idea behind it is hopefully in a couple years, as the government tries to pull us out of this recession, then what will happen is interest rates will go down and you refinance into a fixed 30-year rate. With this 3-2-1 buy down, I don't think year 4 you're ever going to get to a point where you have an actual 6.6%. So a 1-1-1 buy down is exactly what it talks about. They're buying it down one point, which brings the payments from over $4,200 down to around $3,800, and they're doing it for 3 straight years. Same 1 point for 3 years. That's a 1-1-1 buy down. So a temporary buy down, the subsidy comparison, you can see that what a 3-2-1 buy down compared to a 2-1, 1-1-1, 1-0, and 1.5 to half, it shows you what the subsidy amount is. So if you're doing a 3-2-1 buy down, and the seller has to put in almost $30,000 to make that happen. And again, if you're talking about closer to $1.5 million home, that might be $50,000 plus. But remember, we have sellers doing $100,000 price reductions, $50,000 price reductions. For a buyer, it might make a lot more sense to sit there and have the seller put the money towards a buy down than actually lowering his price. So again, give us a call if you have any questions at all, because again, these are whether you're a buyer or seller, if you're a seller and sitting there going, hey, I want to sell my home, or I want to be motivated, or I had my home on the market, the listing expired, and now we really want to get it sold. Hey, think out of the box. It's not just, you don't have to just keep lowering the price. This is kind of almost like when we're selling a house that we have $700 a month HOA dues, and it's a roadblock to having some people buy them. We'll have the seller basically pay the HOA dues for a year or two, which eases the buyer in and gives them a chance, obviously, because everyone's income normally goes up, that they can handle the higher HOA dues. This is the same type of thing. So for a couple years, but this is much better paying $10,000, $30,000, $50,000 for a seller than lowering your price, because when you lower a price, you're lowering it in most cases $50,000 to $100,000. So again, whether you're a buyer or whether you're a seller, if you want to chat a little bit more about this, give me a call. Joe Kehrig with the Kehrig Real Estate Team, 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website to learn more about us, www.kehrigteam.com. Hope you enjoyed this. If you did, make sure that you push the like button and definitely push the subscribe button, and we'll see you next week.